If you're just starting your investing journey, chances are you've heard of the S&P 500. But what is it? Why do people trust it? And what has it done over the last 10 years? Let's break it all down and help you understand if it's the right move for you. What is the S&P 500? The S&P 500 is a stock market index that tracks the performance of 500 of the largest companies in the U.S., like Apple, Microsoft, Amazon, and Google. It's considered one of the best indicators of the overall U.S. stock market. When people say the market is up, they often mean the S&P 500. A look at the last 10 years, 2014 to 2024. The S&P 500 has had a wild decade, but overall it's been a strong performer. Here's a rough breakdown. From 2014 to 2019, steady growth, driven by tech stocks and a healthy economy. 20. A sharp crash during the COVID-19 pandemic, followed by an even faster recovery, 2021. Record highs, thanks to low interest rates and stimulus spending, 22. A rough year with high inflation and rising interest rates, leading to a market pullback, 2023-2024. A gradual recovery with more balanced growth over the 10 years, the average annual return, including dividends, has been around 10 to 12%, which is historically consistent. So what does this tell us? What can we learn from the past decade? The market goes up over time, but not in a straight line. There will always be crashes, corrections, and recoveries. Time in the market beats timing the market. Investors who stayed invested during the COVID crash were rewarded. Those who panicked and sold, many missed the rebound. Diversification matters, even within the S&P. It's not just tech. It includes healthcare, finance, consumer goods, and more. This helps smooth out the ride. Emotions can cost you. Fear and greed are natural, but reacting emotionally to news headlines often leads to poor decisions. Tips for investing in the S&P 500. If you're thinking of investing, here's what you should know. Use index funds or ETFs. The easiest way to invest in the S&P 500 is through a fund like Vanguard S&P 500 ETF, VOO SPDR S&P 500 ETF, SPY. These funds mirror the performance of the index and often have low fees. Stay consistent with dollar cost averaging. That means investing a fixed amount of money at regular intervals, like every month, no matter what the market is doing. This strategy helps reduce the impact of short-term volatility. Think long-term. The S&P 500 is a long-term play. If you're investing for a goal 5, 10, or 20 years away, this is where it shines. Reinvest dividends. Many S&P 500 companies pay dividends. Reinvesting them helps your portfolio grow faster over time through compounding. What to watch out for? Short-term panic. Market corrections are normal. They don't mean the system is broken. Overconfidence during bull markets. Just because it's going up now doesn't mean it always will. Stick to your plan. Fees. Always check fund expense ratios. Even small fees can eat into your returns over decades. Not having a strategy. Know why you're investing, how long your time frame is, and how much risk you can handle. Final thoughts. The S&P 500 has proven over time to be a reliable, simple, and powerful way to build wealth, especially if you stay consistent and keep a long-term mindset. It's not about getting rich overnight. It's about staying in the game, growing with the economy, and letting compounding work its magic. Thanks for watching. If this gave you a better picture of how the S&P 500 works, drop a like, subscribe, and stick around for more videos on investing and personal finance. And of course, this is not financial advice, just information to help you learn and feel more confident.